Right, Kouky, how you going, mate?
I'm really well, Mark. It's been a busy week.
Very busy week. We've had the budget. You and I have not heard the budget reply yet, but the reply comes in tonight. That's Thursday night. You and I are meeting Thursday afternoon. But, you know, like these days, you pretty much know everything that's going to be in the budget and in the reply in terms of policy well before the bloody thing is announced. There wasn't much. Let's just go back to the budget. There wasn't that much that was a surprise or a surprise of any significance. It's probably a better way of putting it, or materiality. They came out of the budget on Tuesday night with Dr. Jim Chalmers.
Yeah, the only thing that took anyone's eye was the income tax cuts, which took the bottom threshold from 16% to 14%. So 2 tranches of $5 a week in terms of income tax cuts over the next 2 years. Everything else related to Medicare, childcare, pharmaceutical payments, defence spending, all those things had been well telegraphed beforehand, had been announced beforehand. So in a way, all we got on budget night was one new announcement and just confirmation of the government's budget numbers. How big was the budget deficit? How much is government debt? So that's why I think it went through to the keeper and will go through to the keeper.
As boring.
It didn't move money markets. You know me, Mark. I have one of my screens has always got the futures up there and what's happening to bonds and interest rate futures and stock market futures. The budget came out. They didn't move. A couple of hours later, towards midnight, the US markets opened. Bang. That's when our markets moved. They reacted more to US economic news than to our own budget.
So just on those maybe we just need to address it a little bit. I don't think you could call this budget inflationary. So I mean, what consumers who are listening to us will be worried about will this either stop interest rate reductions, or alternatively, will it lengthen the period of time before we get the next reduction down, or thirdly, could it potentially increase interest rates because of inflation? Be fair to say that it's not an inflationary budget.
Yeah, I think so. And as we sort of alluded to, those income tax cuts, first of all, they don't take effect for another 15 months, and it's only $5 a week for people on a salary. So that's not inflationary, and the RBA would probably not even adjust their forecast based on that. It's too small. All the other things in there, well, they've been well telegraphed, as we were saying. They've been
What
well
about
known.
the electricity
subsidy? That's been a small extension. They'll actually lower the CPI in the second half of this calendar year.
The headline CPI.
And then it pushes it back up in January the 1st, 2026. But we sort of knew that anyway.
Yeah. So it's only $150.
And again, as we've been arguing or discussing many times in the last 6 months or so, the RBA focus on the trimmed mean, and the electricity subsidies are taken out of that headline inflation to get to the trimmed mean inflation. So when you look at, is it an inflationary budget? Probably not. And again, that's why the markets didn't move when they saw it.
What about in terms of just general worries, economic worries that perhaps we should be having? And I've seen a lot of commentators talk about this. In fact, I don't think I read one commentary in one, either listening to Sky News, which is is pretty predictable what you're going to get there, or even the Fairfax papers, including the AFR. I don't remember having read one commentary that was positive in relation to the budget. Like I didn't see anything that actually gave it a rap.
Yeah, look, the things that were negative to my eye and that commentary that you referred to were more relating to what could have been done but wasn't done. So in a sense, it was not a bad budget. Like, they didn't screw things up. Yeah. In fact, as we said, it was, well, you said boring. It didn't upset the apple cart, to use that terminology. The criticism of many people, including economists like Saul Eslake and Chris Richardson, who I respect completely and utterly, who are the budget gurus, if you like, of the economics profession, that their commentary or criticisms were they should have done more reforming to the tax system. They could have done more reforming to the payment system, which is sort of like, how much do we pay for JobKeeper allowances? What do we do for small business? Should we extend the instant asset write-down rules to next couple of financial years? No, it finishes on the 30th of June this year, although we'll see what happens in the election campaign. But things like that were the criticism. And the other thing was, as was revealed on budget night, the budget deficits are projected for the next 10 years, not just this year or the next year, for 10 years. And that's
got to get funded.
And that's got to be funded. It's got to be borrowed. We know that the budget deficit's got to be borrowed. And when we have a surplus, that reduces government debt, which is why surpluses every cycle are an important thing. But that decade of budget deficits, while it's not a catastrophe, and the deficits aren't as big as they are in the US, for example, as a benchmark.
Or as a percentage of GDP, they're not.
Correct.
I think it's the deficit of GDP, something like 80 or 90%.
We're
37%.
We're 30, so yes. So we're about a third of the level, size of deficit. So we've got a better budget position. However, let's keep it. It's one of these questions about, through a combination of years, Keating, Costello, that reform agenda that we saw, particularly back then, got our budget position in very, very good shape. And then, of course, along came the global crisis and the pandemic. And we had to spend money on those issues. Fair enough. But now's the point, assuming we don't get another pandemic or another, heaven forbid, another deep recession, you repair the budget when the economy's doing okay. And we're doing okay now. So the question will be, whoever wins this election, in the next 5 or 6 weeks, whoever wins, I wouldn't be at all surprised if we have what we might call a mini budget or a budget statement a few months after the election where they say, okay, we've won the election, we've got to give a bit of tough love. We've got to make sure that those 10 years of budget deficits are only 2 or 3 years and that we actually pin our policies towards a surplus in a couple of years' time.
So maybe just explain to listeners a little, because a few little things here, like what's important is that if we are running at a deficit, it's like running your business. You've got to borrow the dough. I mean, if you want to fund your business, you're losing money, you either somehow take it out of your balance sheet. You might have a really great accumulated balance sheet, which we don't have in Australia, which means you've got spare cash. Or alternatively, you go borrow the dough. So in our case, we will borrow. In Australia's case, we will be borrowing the money. So we've got to fund the deficit. We either put the taxes up, which is not very palatable, or we go to the marketplace and borrow the dough.
And like businesses, like individuals, the government pays interest on its debt.
Correct.
Like when we say, the government debt levels, and in a way, as you said, I hope a lot of listeners sort of take stock of this because it's an important issue. When the government has debt, it borrows money and it pays interest on that money. And where does the interest come from? The budget.
Yeah.
So if the government's paying an extra 5 billion, 10 billion a year on interest because debt's gone up and up and up, that's 5 or 10 billion that they can't spend on roads, on Medicare, on education, on small business.
Or they have to raise the taxes.
Or they have to raise taxes, one or the other. So that's why I think it's important that structural balance, that there's nothing wrong with running a deficit 1 or 2 years. When the economy's weak, run a deficit. That's absolutely fine. But when the economy's strong, and if we do get a decent economic recovery next year, fingers crossed that we do, that's when you should be running a budget surplus to cap that level of debt so that those interest costs don't become embedded into your budgeting for the next decade, which makes it very hard to reform the economy. So and yes, and you've got to borrow, and this is the scary thing, the UK is going through this right now. You borrow money to pay the interest. How's that for a government policy?
Yeah, because they don't have enough revenue to pay the interest.
And that's why they're going through mayhem now in their economy again. Yeah, we had the Liz Truss experience, a year ago? Now we've got the Sir Keir Starmer government that got elected, 6 months ago or so. They're trying to fix their economy and they're sort of running after a train that keeps going faster and faster and they can't catch up to it.
And just to be clear, that our debt, our national debt, that is, by the way, we all owe it. Every single one of us owes a percentage of it. Our national debt is just a little less than $1 trillion, Aussie dollars.
Yep.
But if they keep running at deficits, it'll go past $1 trillion fairly quickly. So if you have 10 years worth of deficits, we could be looking at $1 trillion. Well, we will be looking at $1 trillion plus of debt. It
gets to $1 trillion this year. Yep. It just puts its nose above $1 trillion, and then on the current budget numbering, in 2 years' time, it gets to 1.1. 2 years after that, it gets to 1.2 billion. 2 years after that, trillion billion. We get those numbers going up by, give or take approximately 50 billion per year until we get the budget back into balance. Then the debt levels stabilise. And if we get a surplus,
you start paying
it starts coming down a bit. And that's what I think in the medium term, not today or tomorrow. In fact, obviously the budget's only 2 days old. But when we get past this election, whoever wins, I would be happy to see a mini budget that says, okay, people, you mightn't like this medicine, but for the sake of the long-run economic well-being of Australia, that sounds very grandiose, but it's bloody true. We need to sort of do something on tax and spending to make sure that we get that budget deficit back towards zero, and if possible, get it into a small surplus.
So what about off balance sheet? So you and I discussed this last time. So off budget, what they call off budget expenditure, which is not included in the budget, which is like expenditure which you would effectively in business say we're going to capitalize. We're not going to expense it because it's, we're buying an asset or we're creating
capital expenditure. Yeah.
It's sort of, so it seems to be more, from what I could see, more and more money is being allocated off budget at the moment than I've ever seen before.
Things like the NBN is off budget.
And you have to ask yourself the question, mate, like, should we keep investing in the NBN? Like, my God. I mean, why don't we ring Elon Musk up and say, listen, mate, we're going to scrap the NBN, just replace every rooftop in Australia we'll fund it with one of Musk's little satellite dishes, which I've got one of them on my farm, and it's unbelievable. Doesn't miss a beat ever.
I don't know enough about technology, Mark.
Cost me like $400.
No.
I installed it myself.
No.
Like, it's that easy. It's as big as a small carry-on bag on a plane.
Yeah.
On a domestic flight.
Wow.
That's it.
And that's it? Does the job?
Does the job perfectly.
Look, I don't know enough about the technology, but in terms of the budget, and look, the government may or may not do that. And again, we'll wait and see what the coalition parties come up with. They may want to embrace that. I don't know. But for the here and now, the government puts in off-budget balance sheet funding, borrowing, spending, items that, as you said, are capital expenditure sort of items. So things like a lot of infrastructure spending, not just NBN, but other things relating to renewable energy, water, the water supply things, because they seem to be, the reason why they do it, and look, they're in the budget papers, so you can see it, but they're the sort of things that in time, if the circumstances are right, the government then can sell them to the private sector. So back in the olden days, and I don't mean to talk about the olden days, things like Telstra was set up because the private sector couldn't put Telstra in. And then it became a viable entity, of course, and the government privatised it. Commonwealth Bank, Qantas, things that were in the olden days would have been off balance sheet. They became successful companies. They did the job that the government of the day wanted them to. We had our airline, we had a public sector bank, we had telecommunication services. And when they were, mature enough and big enough entities, they were privatised. They came off the balance sheet. See, that when the sale came through, that didn't go into the budget surplus, by the way. That was off the balance sheet as well. So,
but that's the argument. That's
the theory behind it. Yes, I'm just giving you the theory. But nonetheless, as you quite rightly pointed out, and again, I don't mean to hark back to Chris Richardson, but I will because he's such a budget guru. He did this lovely chart. I'm sure if you just go through his social media pages, you'll find it on the evolution of off-budget measures. And, in the last 10 years, it's bounced up and down a little bit, but it's started to increase quite strongly now.
Yeah. And I mean, and there are some things that they should be doing.
Definitely. Yeah, that's it. So it's not all bad.
There's some things that like the Northern Rivers sort of relief and all that sort of stuff. I mean, there's
inland rail,
1.2 billion or something was allocated.
Stuff like that, which is important.
Then there are things that have to happen. But for me, man, I'd rather just see everything in the budget. I just don't like this business. I just think most people don't even watch the budget, but let alone have a look what's off budget. And I think Australians should be aware that our budget is going to be in deficit for the next 10 years, potentially. We got to borrow against that. And our budget, and we are also spending money off budget, like significant amounts of money. It's not like there's a small amount of money. It's 100 billion.
It's up to about 100 billion, in the budget estimate.
Which we're going to borrow.
Correct. Well, that money is still borrowed. Yes, correct.
More borrowing.
Not in the it's called the underlying cash balance, which is the one that we all focus on. That's that $27 billion deficit for this current financial year that we're talking about. But there's 100 billion of accumulated investment / spending that's in the off budget balance sheet of the government.
So, and I guess, by the way, none of this is probably going to affect interest rates, right, for the moment. I don't think so, but I think it's just a good context for us to understand. And I know, we all know that Dutton's going to do his reply tonight. There is some talk about helping out in relation to excise tax or reduction or temporary reduction in excise tax on fuel, which I quite like the idea of it in that it could have an immediate benefit to definitely to small businesses, but hopefully it could have an immediate, a quick benefit, I should say, to inflation, because it may well reduce the cost of items.
Petrol has a high weighting in the inflation
totally.
calculation, so it'll definitely kick the headline inflation lower. But a little bit like that electricity subsidy, the RBA will see that, and they can see that it ends in 12 months, and they'll say, "Oh, look, we won't take that into account," even though we consumers who spend money on petrol every week will think, "Thank God, I'm saving a bit of money on my my tank of petrol." Yeah,
so it could put a bit more money into people's pockets. Consumers' pockets, and do you think that could be inflationary?
Like the income tax cuts,
probably not enough.
At the margin, it is, but I think the RBA would look at it and think, well, no, it's not the sort of thing that's going to spook us.
Yeah.
The RBA have got much bigger fish to fry. With what's happening with Trump tariffs, with what's happening, I suppose, in the actual inflation numbers that are coming out now, and they're nice and low. They've got bigger worries concerning their estimates about what's happening to the labour market. And don't forget, we've got this funny situation, we'll probably touch on this a bit later, where the most recent labour market numbers had a minus 53,000 for employment. Now, some people say that's just noise in the Bureau of Statistics, but if that's the start of the trend, if we get another negative next month, and who knows, we don't get the next labour force numbers for about another 2.5 weeks. But if they're another weak number, then wow, that really puts a curveball into that whole assessment that the labour market is tight, because it won't be.
So can we just talk about that for a second? So
sure.
And this is taking us back into the inflation discussion.
Yep.
So labour market is obviously one of the top three things really important. I noticed in the budget of Dr. Eugene Chalmers, that he talked about a 4.25% unemployment number.
Yes.
Now that's a fairly big increase from where we've been hovering for like some time now. We're at 4.1.
We've been hovering around 4 plus or minus 0.1 or 0.2 for the last 12 months.
So a 0.25% increase, 25 basis points. It's fairly significant.
It's noticeable.
But
in the historical context, it's still okay. And if that's what I don't want to bring up Nehru, Mark. I don't want to do that, because I know we've laboured that to death at various times in the past. But if that's what Treasury think is happening to Nehru, and it's 4.25%, and we're at 4.1 today, and as I said, we had a big negative on employment. If we get another big negative on unemployment for the next couple of months, we'll be at 4.25 before you can blink. Because we're not that far as we sit here today. Yeah. So, and anecdotally,
I'm hearing there are a lot of businesses going bust.
Yep.
Like a lot. I saw
small and medium.
Yep. Totally. Like not just in the food industry, but food's probably been most heavily affected. But like clothing businesses, for example, Jeans West, I think, has recently applied for administration. They're going to keep open their online store, but I'm talking about all the physical stores. Do you think that we are continuing, notwithstanding that inflation, we'll talk about inflation numbers in a moment, but we are starting to head into a pretty difficult period now?
The short answer is that, as they say in the classics, we're not out of the woods. We did have in the December quarter last year, so the last 3 months of 2024, a bit of a pickup in retail spending. But we had Black Friday sales, and the Christmas period was pretty good. I wouldn't say it was booming, but it was pretty good.
Better than expected.
Definitely. Then we had the new year come in, and people probably got their credit card bills and a few things like that. Retail spending was minus in January. It was a tiny increase in February, and in line with consumer sentiment, went up a little bit when we had the rate cut back in the middle of February. Whoosh, it's come all the way back down in the last couple of readings.
Consumer sentiment.
And that's a good leading indicator of what's happening to consumer spending. So that's the long-winded way of saying I think consumers are still under pressure. That while the rate cut occurred a month ago, I think, thank God for that. It happened. And yes, that's a bit of relief for people with debt. But it's not quite like the $5 tax cut, but it's not enough to cause people to say, I'm okay now. I've got plenty of spare cash, because all it does is just give that initial bit of relief. That's great. I'm not downplaying it for 1 second, but it's not the sort of catalyst that makes people think, all of a sudden, my mortgage repayments are down big time. I'm going to go out and spend. I'm going to go to restaurants again. I'm going to book my overseas holiday. We're not in that space yet. So I think the consumer side of the economy is still where there's weakness, they're hankering, we consumers that is, are hankering for another rate cut. Whether how soon we get that, of course, we can chat about a bit later. But for the here and now, we've also got this experience too where wages growth, which did kick up last year, that might have fueled that better retail spending at the end of last year. Wages growth reduction is now slowing. We had the tax cut, yes, on the 1st of July last year. The last quarter of last year was good. Where's this extra injection of money to allow us as consumers to go out and spend? It's just not there unless we get more rate cuts. And I think that's the $64 question.
So you might explain how we are getting monthly numbers as opposed to just waiting for the quarterly. The next set of quarterly numbers that we would expect. So we got the end of January numbers. The 31 December numbers come at the end of January. The 31 March numbers, which is like this weekend sort of thing, don't come in until the end of April, like correct. After Anzac Day, I think.
Correct, that's
around
correct.
The territory.
The day after
but then we have to wait for the next Reserve Bank meeting after that, which is in May.
Middle of May.
We do have a Reserve Bank meeting coming up in
April 1st.
1st of April, which is like
next week.
But they got data. Let's talk about the data that they currently have. So, and also let's talk about the weight that they would attach to that data. So the data they have is really monthly data.
The monthly inflation numbers came out earlier this week, and they were encouraging. To be blunt, for the last 2 years, you and I have been discussing inflation. When will it get back to the target range? How's it going to get there? The numbers that came out earlier this week for headline inflation, annual terms, 2.4, and remembering that the target band is between 2 and 3%. So a little below the midpoint. Hooray. That's great news. And it's been between 2 and 3% for 7 months now.
Headline.
Not just a 1 month wonder. It's now 7 months, and it looks as if headline's entrenched there.
Yep.
Now, the trimmed mean, as we discussed many times as well, and just recently with the petrol prices and electricity subsidies being excluded from headline inflation to get trimmed mean, even that came in at 2.7%.
That's very encouraging.
Just that much above the midpoint of the target. And again, that's 3 months it's been in the 2 to 3 target. So you said encouraging. Yes, it's really encouraging. And so in theory, with inflation back on target, you'd say that the bias of the Reserve Bank is certainly towards cutting interest rates. Whether they've got the wherewithal or the evidence that they need to pull the trigger on the 1st of April, it's probably not the case. It's not really being priced into the financial markets at this stage. But that inflation number was, one of those ones you think, oh, that's great news. We've got a little bit of good news coming on inflation. And, when we've gone through, 2 tough years of really high inflation, getting a little bit of better news on inflation is something that I'm sure the Reserve Bank had a little jig in their room and had a celebratory cup of tea when they were up there.
So, but even though that number's come out, let's look at you mentioned the word evidence, and the Reserve Bank is evidence-based. They make decisions on evidence, but mind you, you and I disagreed on the February rate. And by the way, what was interesting, she did what you said. She did reduce the rates, but then in her speeches after it, she sort of started telling us that, look, don't expect any more.
That's right.
So she should have had a bet both ways. But and it looked like to some extent, what's amazing, after that rate reduction on the 18th of February, and after her speech, all of a sudden, all these economists came out and started saying, we were saying that we should put the rate down. I thought most economists would be unanimous, except for me and maybe Hogan, were saying it's not. I didn't think we were at the right spot just yet. I want rate reductions, don't get me wrong, but I just thought we weren't at the right spot in terms of evidence. I'm talking about it wasn't sustainable. I wasn't convinced of the evidence being consistent enough. If we just look at that now, though, Steve, in terms of it being acceptable evidence, you've got to look at the weight of the data that's coming to us as opposed to the number.
Yep.
And these are monthly numbers. Yes. So the only way I could justify her 18th of February rate reduction was off the back of the December quarter inflation at 0.5, which if I extrapolate that out 12 months. Well, sorry, camera. If I extrapolate that out 12 months, we have a 2.
Correct. Yeah. And I think that is the nutshell. You've got it in a nutshell. That quarterly trimmed mean inflation number at 0.5 was the number that allowed them to go 25, but with a huge amount of caution. As you said, here's a rate cut, but don't get too excited about another one being around the corner.
And so in the monthly numbers that we're now you and I are now talking about, let's talk about inflation or CPI. What is the monthly CPI we're being shown, and what does that extrapolate out to?
There are many good economists who analyse the CPI because it's such an important part of what they do. The Westpac team, Justin Smirk, I think, is the senior economist who looks at the inflation rate. I think he's great. I love his work. When he saw the February monthly inflation number, because the monthly numbers do feed into the quarterly, there is an overlap, but they're not the same.
But they adjust them though.
They're not the complete inflation number. That's why the quarterly numbers are so important. The monthly numbers are sort of like the score after 20 minutes of the game. Handy to be ahead.
Indicative.
But you're not winning the game.
They're indicative only.
They're indicative only. And these two monthly numbers are a good start. Yes, I'm happy and I'm sure they're happy. But Justin put in his note the other day that on his current thinking, they're going to be getting a trimmed mean inflation rate similar to the 0.5 that we saw in the December quarter. So 0.5 or 0.6, I think, was his forecast for the March quarter result that we get at the end of April. If that's the case, so we'll have just to say it's a 0.6. Let's just be erring on the side of it being a little up
at the end of March.
We'll have had a 0.5 and a 0.6, and so we've got 2 quarters, half a year, where if you add them up, it's 1.1. You annualise that, it's actually around 2.25%, 2.2%. So that's why the May meeting of the RBA board, May 17th, I think it is off the top of my head, is the one which is so-called live, which many market economists, again, not all, but many are thinking, well, that's when the RBA is going to pull the trigger on the next rate cut. So they need that quarterly number, which incorporates estimates of services inflation, the price of a haircut, which I desperately need, rents, insurance, all that
school fees,
banking, finance, school fees, all that services stuff, car maintenance and things like that.
Insurance.
Insurance. So it's not bananas and takeaway food, and
because they're all behaving quite well,
and electrical items and all this stuff. They're the goods prices as opposed to services. They're actually well and truly below the target range. It's that services which the RBA's sort of focused on and been reluctant to sort of follow through with that rate cut because services was high. So if we get that number coming through
in April,
at the end of April, and it is 0.6-ish, I think that's game on for a rate cut in May.
Well, you would expect it has to be a game on for rate cutting in May, because if she cut in February when it was 0.5 at December, and by the way, every quarter before December, September, June, March were not 0.5.
Well, in fact, the ones back in March last year was 1.0.
Yeah, much higher.
That drops out of your year-on-year run rate. Yes,
correct. So if she dropped rates on the 18th of February off the back of a 0.5 for the quarter at ending December, and if we get a 0.6, let's say 0.6 at the end of March, which is only a couple of days away.
0.6 times 4 is 2.4.
So it's got to be late, Emma, there that she's going to reduce rates on the same logic.
On the same logic. So we have to see that number coming out first.
Same logic, yeah. So what do you think the risks are to a 0.6? I mean, are you seeing something in services or in goods that is presenting perhaps a risk?
No.
Tariffs?
Tariffs are going to be later rather than sooner. The tariffs implemented by Trump on the 2nd of April is going to be the biggest tariff issue, but it takes a little while for that to permeate through the system. And the RBA will be watching it. We're all watching it. It's a very important issue, don't get me wrong. But I think that's more a potential problem for later in the year rather than sooner. And the inflation risks, again, so we've had 2 months of the quarter coming out nicely behaved. Then you look at things like what drives services inflation. It's predominantly wages. So the price of a haircut's not the price of scissors and that sort of stuff. It's the price of the labour of the person who cuts your hair.
Yep.
And if wages are going up a lot, the price of a haircut goes up a lot. And in fact, the fact that wages are coming down a bit, the growth in wages is coming down a bit, is really encouraging for the services type inflation. We've seen things like dwelling rent starting to ease. So rents are still going up, don't get me wrong, but the rate of increase is getting lower because we have a bit more of an uptick in the rental vacancy rate. Again, not much, but that rents problem, the acute problem that we had a year ago is now just a mini problem, if I can call it.
And what about the reduction in immigration? How does that help?
Yeah. That is a really important issue. So we've got that one of the reasons why house prices kept booming, to be frank, when we had interest rate hikes, a year and two ago, was there was just incredible demand. Immigration was massive. We weren't building enough houses. The rental market was as tight as a drum, and that spilt over into prices. So the fact that the government's now targeting a lower net migration intake, and that was confirmed in the budget the other night, getting back to where we were pre-pandemic, which I think was sort of like an equilibrium, if there's such a thing in immigration, takes some of the pressure off that housing market, which takes some of the pressure off the inflation rate. So that's like good red wine. There's an optimal amount of immigration. Too much, you have a nasty hangover, and we had that a year and two ago. Too little is no good either, because immigration, with certainly the humanitarian part of it, but there's also some skilled migrants that come in here. And so if we target our immigration well, we can have the tradies that we need to build all these houses. We can have the IT gurus to do artificial intelligence, and they can be an important part of Australia's longer run economic development.
So what other numbers have come out apart from the CPI for the monthly basis?
The employment number, which we touched on a moment ago, the February employment number was a shocker, to be blunt. We've had
which way? Shocker, which
down.
way?
We had a bad number. So we've had 2 years of fantastic
employment or unemployment. The
employment
number. In other words,
the number of jobs fell 53,000. This is according to the Bureau of Statistics. Yep. And remembering, the monthly numbers are incredibly volatile, and they're done from a survey.
Yep.
And they can bounce around a lot. So that 1 month, we don't get too excited. We want to see 2 or 3 months to see whether there's a trend. But if you take them even half at face value, in the context of the prior month too, which, by the way, was revised lower, you've got that incredible employment boom that we saw during 2023 and 2024, kicking off 2025 with a clear turning point. If you looked at a chart of employment creation in trend terms, so you took out that massive seasonal number, the minus 53, it's slowing. Again, not a problem because, as you correctly anticipated, the unemployment rate was steady at 4.1%. And as we said before too, the unemployment rate's been 3.9, 4, 4.1, 4, 4.1 for a year. And that's a good result. As the RBA governor says, she's very happy to see unemployment around 4. What we don't want is to see it go to 5, which, as you said in the budget papers, isn't the forecast. So that's one number that's come out that if the RBA had a stronger bias towards cutting rates, they could sort of wave their flag and say, oh, look, the labour market's weakening a bit too, because we had that minus 53,000 for employment.
Yeah, so and I think that's important. Also, GDP, and I know we're going to cover the board in a moment, but one of the things that's really interesting about GDP that I've always thought was pretty fascinating, mind you, most people don't, but is that immigration drives GDP. Well, because
yes, it does.
Because it's sort of like
I think an economic purist would say immigration plus productivity.
Yeah, okay.
we've had crap productivity, by the way, for a couple of years.
Immigration does add to productivity, but if you look at the total productivity, it's even better if you have a greater percentage of productivity. So because just by definition, more people here are going to drive more productivity because they're going to produce more shit. More stuff, I should say.
Yes.
But our productivity as a percentage is quite low.
It's been very poor for best part of a decade, to be frank. Yeah.
And I mean, on top of that, you can look at the unemployment number or the employment number. And the biggest problem with the employment number at the moment is most of the new employees, and I saw some numbers around the other day, more recently, 80% of most of the new employed people have gone into what would be considered non-productivity jobs.
They've gone into public sector inspired, even though some of them are employed by the private sector, they've been employed because of government assistance for childcare, for aged care facilities. So the nurses that work in a nursing home, for example, might be a privately owned nursing home, but the nursing home's employing them because they're getting a subsidy from the government. So you're quite right. I think it's roughly 80% of the jobs created in the last year or year and a half have been, what do we call it, inspired by the public sector spending on health, education, aged care, all that, NDIS, all that sort of stuff. And yes, their productivity is very hard to measure. So one example, and this is what I love about productivity, as in, I don't think we can bloody measure it.
No, I don't either.
What's the productivity? Just say a nurse, works in a hospital, he or she do their shift. How do you measure the productivity? How many sick people they look after that night? Or, and I got into trouble for saying this. So what's the productivity of the Reserve Bank? Do they write more reports? No, that's not more productive. Do they make, so how do you get more, or something dear to our heart, a rugby league player? Just take, I don't know, Latrell Mitchell when he's fit and well, playing for South Sydney. Go the Rabbitohs. How does his productivity improve? More goals, more tries, whatever? Nathan Cleary, there's getting back to that services side of the economy, and how many haircuts can you do in an hour? Even the best haircutter in the world can only do a couple in an hour. So the services side has productivity measures that can't be measured. And that's not being critical of the Bureau of Statistics or whatever. Whereas if you're a miner in the mining industry and your company buys you a new digger and a new truck and a new rail system, you can probably quadruple your output of iron ore or gold or coal or whatever the hell it is because of machinery in your product. You produce twice as much stuff per person. And that's where productivity is easily measured. In services, I don't know. I genuinely don't know how.
Well, they don't know either. They don't measure it.
Correct. And in fact, so obsessing about productivity, I think we might be taking our eye off the main game.
Although the RBA,
I do like high productivity, but I think we're not measuring it. But
the RBA, it's a big deal for them.
The RBA it's a great big deal for them. Yes,
because it's productivity and wages increases.
Correct.
And unemployment or employment. They're sort of like have a little algo sitting on all that stuff, which they like to sort of use as a measure as to whether or not we need to either reduce interest rates or increase interest rates or leave them the same. But that'll be an interesting one with GDP going forward. And actually, my gut feeling is that GDP, pulling productivity aside, but GDP will reduce over time with a reduction in immigration. It looks like, if GDP reduces, that's one of the things the Reserve Bank is very interested in because they don't want to get that. They get marked. I mean, we've got to remember this. Everybody wants to do well in their job. And our Reserve Bank governor, she wants to be seen as doing a great job. And everyone just thinks her job is putting interest rates up and down. No, actually, her interest rate is to foster growth in our economy and
the well-being and prosperity of all Australians or something like that.
Well, it's the prosperity and welfare of all Australians. They're the words. And the measure of prosperity in terms of her mandate is growth, GDP.
Growth, jobs, incomes, wealth creation.
Yes. And the measure of welfare is unemployment, for example.
Unemployment, and the measure of output is GDP growth. So a strong economy that's producing more stuff is a good economy.
And she get measured like that. And it's human nature. I'm going to use interest rates to make sure that, I do my job. That's what I'm here for. I get paid $1 million a year. I got to do my job and my team.
That's when she was appointed, 18 months ago by Jim Chalmers? That's what you got to do, Governor.
So GDP will be an important one for her. Where are we at with GDP? Have we had any reads on it?
We had the December quarter data again coming out in early March.
It was very low.
Which was a 0.6 for the quarter, 1.3 for the year, 1.3 annual. So it's best to focus on the annual in a way because that's your because again, quarterly numbers in GDP are even more volatile than the inflation numbers. Yes. And it can depend on if there's a flood in a coal mine in Queensland, output drops by 0.2 just from that, so there's a whole lot of things that impact it.
So what is the impact of the floods in North Queensland and South?
Negative.
Quite high.
It's because a lot of places shut down for a long time.
There's a few points in it, as I understand.
I think that there's about 0.25% off GDP growth for the March quarter when we get
not
those
for the
numbers.
year, but for the quarter.
Yep, but as we hope now that the floods have gone away and people are back and people are not hunkering down because of this cyclone, they're out and about shopping and replenishing their pantries and things. So hopefully we get June quarter numbers, heaven forbid we're going a long way into the future there, are going to be a little bit better. But for the here and now, it's bad. Yeah.
So then just on that, I mean, how do we sort of reconcile that the government or Treasury and or the Treasurer have made an assumption of, I think, 2.5% GDP?
Yep.
And it's important for them to make that assumption because they've got to work out how the country is going to grow in order to work out how much tax they're going to collect.
Yes,
or extra tax they collect.
That's why those forecasts are important. Yeah, correct, exactly.
And therefore, the extra tax I collect tells me how much extra money I've got to spend.
Yep.
And or how much I need to borrow.
Yep.
So they're looking at a 2.5%.
Correct.
It's an interesting question, a little bit not quite related to interest rates, but how do you reconcile Treasury's 2.5% GDP growth for the next 12 months relative to, say, looking at a number at just under 2, around 2, off the back of our historical growth numbers, GDP
compared with what you and I have been used to over many decades? We used to have the Australian. I remember the 333.
It used to be
3 and a quarter.
Yeah.
3 and a quarter.
I've never, by the way, very rarely have I ever seen it.
Not for the last decade.
No, I haven't seen it for a long time.
Not for a long time. We did get it in the 80s and 90s.
Yeah, but I haven't seen it in the last 10 years at least.
We might have had the odd quarter where it spiked up, but it hasn't been sustained. So the fact that the budget papers have 2.5, 2 and 3/4 might be 1 year into the future. Certainly not 3.
No.
And that's with decent population growth, as you were alluding to. So people coming here and buying and spending, should be boosting GDP. I think it's a function of the fact that we're more of a mature economy, and that's not meant to sound too boring in a sense, but the aging population is still an issue. Old people spend less than young people. We've already got our house, we've got our car, and we don't want to buy more things. We sit at home and watch TV rather than going out clubbing all night. Well, speak about my kids rather than me. No, but so the aging population just lowers the growth rate in one sense. And I think the other thing which is sort of just dampening our growth momentum is, as we're alluding to, and even though we can't measure it, is that productivity boost is not there. Back in the day when we had 3.5% GDP growth year in, year out, we were reforming our economy, and dare I say, thanks to you with Wizard, reforming the banking sector, the benefits that reforms like that, our banking and finance.
Paul Keating.
Yeah, all that sort of stuff.
He did that.
Floating the dollar.
Okay. And Keating deregulated my industry, allowed people like me to do it.
And floating the dollar, things like that, just allowed our economy to be vibrant for a decade or two. Putting money into super. I know we've still got that coming, but their super funds have got lots of cash. They're investing it and growing the economy. Reforms like that were how we were able to grow the economy, and we were a much younger society then too. And it was that reform agenda, which comes back to our question at the very beginning about what should the budget have done better or done more of. And this is again that what do we do to reform our tax system, our spending system, regulatory environment, to ensure that business people, who will be the driver of long-run economic growth, sure, the government can spend money this year, and that's handy when we've got a weak economy and we need to get more nurses and aged care. That's fine. But if you're to sustain a good, decent rate of economic growth for 5 years, for 10 years, you need the private sector to kick in. And that's just not consumers spending.
Incentivise, though, to do it.
Yeah, so consumers spending, that's fine, but it's really CapEx. It's really business investment, buying machinery and equipment, investing in AI, buying the buildings and structures that you need for warehousing, for hotels. So tourists can come in and stay at a snazzy hotel, eat at a snazzy restaurant, pay us lots of money, so we Australians become richer from things like tourism. That's the drop. So it's the private sector investing in machinery, buildings, AI and sort of artificial intelligence and technology that have been the missing link. And if you look at our CapEx numbers over the last decade, they've been rotten. The US has been booming with all its CapEx, and I know they're the poster child, if we can call it that, of the last decade or two of technology. We've been really lagging. And I think that's where the discussion about how do does the government encourage the private sector to pick up and bloody run and grow the economy, hire people and pay good wages and all this other stuff. It comes back to things like the regulatory environment, the tax environment, which are hard to reform. no doubt. Neither side of politics has done it for 2 decades. The last big tax reform was the GST and related tax policy. God, mate, 25 years ago.
Yep. John Howard.
And this is where we need to have perhaps a rethink. And you've got to take the people on board, the voters on side, and say, hang on, things are okay. Australia's still a bloody good place. We're still a great economy and great society to live in. But we need to have a bit of a frank discussion, some tough love even. Not everybody's going to win, where we have to reform our tax system and how we have to recalibrate our spending programs to ensure that in the next 10 and 20 years, we and our kids have a even better economy to live in, because that's what Hawke Keating did, and certainly the first part of the Costello as Treasurer years did, with a whole lot of the Future Fund and the GST and things like that. There was a 2-decade period roughly of good reform, and we're still benefiting from that. We need to re-enter that phase, and I say we need to redo it sooner rather than later.
So if you were looking at, or if you're talking to a consumer who's interested in interest rates going up or down, and if the Reserve Bank is interested in knows it's going to be measured for its prosperity mandate that is growing the economy, and they're going to be measured by GDP, what number is the Reserve? Do you think our consumer or our listener should be looking at for what the Reserve Bank's looking for when it comes to GDP?
Yeah.
You mentioned historically, many years ago, 20 years ago, it was in the threes.
Yeah.
The Treasury in the last budget took 2.5, whatever it was.
Yeah.
Where does the Reserve Bank hope? Because we know where they want inflation, between 2 and 3. Where does the Reserve Bank want to see GDP? And so for example, if it comes in at 1, for argument's sake, annualized,
rotten,
we would expect a rate reduction.
Oh God, yes. That's not good news.
It's a silly thing for me to say.
If we got 4%, we'd be hiking.
So
rates.
where do you think we want to see GDP number at?
Yeah, if we can, and again, just abstracting from that volatility that we mentioned, because there's an oil shock or water in Lismore and southern Queensland, whatever. Ideally, the what do we call it? The Goldilocks, not too hot, not too cold, but just right. I would say it's going to be between 2.5 and 3.
Right.
So not saying 2.75, that's too precise. But if we got GDP growth 2.6, 2.8, 2.7, 2.9, that would be the sort of level of growth in the current structure of our economy that would create enough jobs to keep the unemployment rate low, to allow for moderate increases in real wages. So the workers are happy, businesses are happy to pay a bit of a pay rise, but not too much, not too little again. So if I was to sort of put my hand on my heart and say, well, what would be our optimal rate of GDP growth, and for the Reserve Bank, more important than me, I would say to be about 2.75% plus or minus a quarter, of just allowing for the volatility.
So if in the May decision, we've had an April GDP number come out. Is there an April GDP number?
No, there's not. We don't get one till June. No, we don't get the bloody next one.
But we get monthlies.
GDP, no
GDP monthlies either.
No, it's only the CPI that's gone monthly. We only get quarterly GDP, and the only one that we got was about 3 weeks ago.
Okay, so the one we got 3 weeks ago for the December period
was 0.6.
Yes, so that is 4.6 to 24. It sort of doesn't really say rate reduction or rate increase.
Don't forget that 0.6, while it superficially looks quite good, it was after, I think, 4 quarters of rubbish, 0.2. So you've got to put it in again, like our inflation numbers, put in the context of the quarter before, which was a shocker.
If you take a yearly number, it's
1.3.
It's 1.3. Yeah. But if they do what they did for inflation and they just take the latest read and extrapolate forward,
and analyze it,
it's not that exciting when it comes to looking at perhaps getting a rate reduction. So, but what I'm trying to cover here is the top 3 ones. We're going to go through your whole list in a moment, but we're at a really interesting point here for this. I don't think for the meeting that we're talking about next week. I think for the meeting in May.
Sure.
So I have a view on the May meeting, but it's going to depend on the data, of course. But what people should be looking for is, in order to get a rate reduction, is hopefully is well, we won't know anything for GDP, but we can take, the latest number for the December quarter, and we can also take all those quarters prior to that for the previous year in 2024, and we've got a pretty crappy sort of GDP, so that's a tick. And then inflation, we're sort of heading in the right direction, which you've just covered off beautifully, and labour markets in terms of unemployment, I'm talking about, as opposed to employment, but unemployment.
Yes.
It's looked like it's going to track. Even the Treasury says we're going to look at a different number, a number with above 2%. So we're looking at 2.45%, 2.25%, 2.45. Is it 2.45?
4.25.
Sorry, 4.25.
4.25 for unemployment rate. Yes.
4.25. We've got dyslexic there for a moment. 4.25. So that augurs well. So there is some hope out there on the horizon.
There is hope, and
but I don't feel all that excited about it.
Mark, where the excitement will come, I'd say assume the RBA do nothing next week. From then until the May meeting of the RBA board, there will be three numbers only that will be, I won't say only, but three numbers that will be the creme de la creme of whether we get that rate cut or not. Critical will be the March quarter inflation numbers.
Which comes at the end of April.
End of April, we've discussed that. 0.5, 0.6 for the trimmed mean, game on for rate cut. 0.7 or 0.8, that'll be a spanner in the works. The other two numbers are the two monthly employment numbers. So we'll get one of them in a couple of weeks' time, the middle of April, and there's one that comes out just before the next RBA board meeting. We will be able to validate or otherwise that minus 53,000 in employment. So if it bounces back 53,000, well, it was just a statistical anomaly. If we get minus 53 followed by 0 or even a plus 10, it's pretty weak. And the unemployment rate, again, that unemployment rate, because 4.1 and it doesn't take much for it to get to 4.2 or 4.3, then again, it's game on for the rate cut. So if there were only three things that I was looking at, and of course I'll be looking at a whole lot more than that, between the April meeting of the RBA and the May meeting of the RBA, it'll be the two labour force numbers and the CPI, all the while having an eye on Trump tariffs. 2nd of April is the big day for exactly what form they take, whether Australia's exempt, which we won't be, by the way, or I don't think we will be, on steel, aluminium. He's talking about copper. He's talking about tariffs on cars. Now, that doesn't affect us because we don't make any cars, but we supply a lot of the minerals and materials and metals that go into car production around the world. So if cars get hit, then maybe will be less demand for our copper and our iron ore and things too, and aluminium. So I'll be looking at that to see whether that has any, what we call it, a blowback on our economy.
So let's go through your board now.
Right, the board.
Okay, the legendary board. So let's look at it.
Monetary Policy Checklist Board. Okay, we mentioned GDP. That is clearly in the neutral, slightly towards easing. It's picked up a bit, but it's not strong. You wouldn't hike rates on your GDP result. Inflation. I'm excited about inflation. I'm moving that almost to the easing. We're in the middle of the target range, but inflation is coming down. And if anything, it'll be lower in the quarters ahead. But as we said, watch the March quarter numbers out at the end of April.
Yeah, and should be clear, this is for the April meeting.
This is the April meeting,
What we're now doing is one April meeting.
Because we'll do the May meeting next when we've got those numbers.
Yep.
On the labour market, I'm putting it at neutral because 4.1 unemployment is still pretty good, and we're not sure whether that minus 53 is valid, as we've discussed. So it's certainly not tightening, but it's not so catastrophic that they need to urgently cut rates because of the labour market. So that's neutral. Where we get to the easing, wages. We've had the wage number came out after the February meeting, 3.2% annual growth. It's slowing, so wages aren't a problem. International economy, I'm going to put that in easing. We've got rate cuts. Well, the Fed was on hold in the US this last meeting, but the Kiwis have cut. Canada's still cutting. European Central Bank cut. Bank of England was on hold, but they've still got an easing bias. So global rates are either steady or low, and that's after a whole bunch of rate cuts. And the international economy's on edge over the tariff issue. So I'm putting that in the easing side.
Whatever happens, something's going to happen from the tariff issue. So
it'll be big. And yes, we can't forecast that.
Yeah, no.
It's like trying to forecast the effect of a war or something. Who knows what happens, but it's not going to be good. I think we can say that how bad will it be is the only question. House prices, I'm putting that back in neutral. They've actually kicked up the last 6 weeks. We had a bit of a period late last year, maybe in January, where house prices were flat to slightly weaker. Auction clearance rates are up a bit. House prices in the weakest city, which was Melbourne, have just kicked up a little bit. Sydney, which was weak, again, I'm not talking about any big increases, but more
They're not
steady.
falling.
And the RBA won't even care about it. They'll be thinking, we're not worried about housing. It's not a boom. It's not a bust. Retail sales, I'm putting that in easing with consumer sentiment. So those two go hand in hand. Consumers are gloomy. Spending, as we discussed, has been pretty ordinary. Building approvals. I won't put that in tightening, but we're actually starting to build a few more houses. That the building approvals numbers are trending up, not super strong and coming from a really low base, but we've got the housing cycle supply side response, the construction response, starting to pick up. Again, I'm not going to put my hand on my heart and say, we're in for a building boom. Probably not. But it's better to have a plus sign than a minus sign. It's one of those things. Business investment, that was a shocker. That came out last quarter, negative. Businesses, we're saying that business investments are the what do we call it, the driver of productivity. Businesses have got their hands in their pocket right now. And I think part of that's due to the election.
Yep.
So, and particularly with things like renewable energy, nuclear versus solar and wind and all that sort of stuff. If you're in that space, you're going to not do anything until you know who wins the election.
You want to know what the policy is going to be.
Yeah. And so businesses are saying, well, who's going to win this election? I'll make my decision to invest or not to invest when I see who's in power. And similarly, business confidence, taking a dive into the negative territory over the last couple of months from the NAB survey. Commodity prices, neutral. China's had some policy stimulus in its economy because its economy's been very weak. And to the extent that we've got iron ore still at US $100 a tonne, it's good news. Oil prices are down a bit, but just stabilising, neutral only. Stock market, taking a hit.
Finally.
I'm moving that to sort of, I won't put it in easing, put it more in neutral. And the current interest rate settings, they're restrictive. So what that means is that you're coming from a high base and that if there's anything in interest rates, it's only down, not up.
Yeah.
So you can see from the board, and the ones that matter, I think, Mark, you made this absolutely vital point when we look at this board. These are not equal issues. The ones in the top 3, maybe even the top 4, include wages, are the things that are dominant for the RBA. And you can see they're neutral to slightly easing, which means for next week, RBA's
1 April.
1 April, 2:30 in the afternoon, Sydney time. You will see the RBA probably hold, but will have its language and its statements about how they read the economy, saying we are inclined to cut interest rates if the data on inflation, the labour market, continue to weaken as we expect.
And on this meeting between you and I, our interest rate meeting, I'm in complete agreement with you on this one. But I do think, I'm actually really going to be very curious as to see whether or not our Reserve Bank governor throws the wet blanket over all the positives that you've talked about, just to make sure we don't get ahead of ourselves thinking there's going to be a rate reduction in May. Like she did in February. I'm just curious. I'm not saying she will. Yeah. I'm just curious to see whether she'll do what she did in February.
Well, her track record, she's been governor for 18 months now. And she did a hike in, November 23 and one cut in February 25. But all of it, and the fantastic thing about the Reserve Bank now is that they do the press conference after each RBA meeting. And the questions now from the journos are really good. The first couple, I think they got a bit excited and asked, are you going to cut or hike rates? So they're pretty dumb questions. All due respect to my journalist friends out there. But now the questions are really good. They're actually drilling into some of the issues that we discussed.
Yep.
And not blowing up our own tyres here, but they're discussing things that are really important to that interest rate decision. And to her massive credit, Michelle Bullock is a very good communicator. And yes, your point, will she, when she's asked this question about, what are the pressures on interest rates, she'll say, I'm not ruling anything out, anything in or anything out. We probably have a predisposition, a mild predisposition towards cutting interest rates, but we need the inflation rate to be lower before we'd even consider it. Something like that. And
if you were to be asked the question, if you were the Reserve Bank governor and on Tuesday and someone asked you the question, Mr. Koukoulas, in previous periods, and by the way, we have to go back to before 2010, but in previous periods, the general rhythm of rate reductions was 5 or 6 rate reductions.
Yes.
And the general rhythm of rate increases, by the way, is 5 or 6 too. Of course, there's been a lot of intervening weird periods, including the GFC and COVID. But what would you say that would you and leaning into money markets right now, would you say that we got 100 basis points in us? In other words, 100 basis points worth of reductions get us down to like 345 or 325 or 335, whatever, something like that.
Yeah, I think if I'll say what I think the RBA governor will say, and she sort of said this, and so is the deputy Andrew Hauser, that the neutral interest rate, and while it's an academic exercise, what the neutral interest rate is, it is actually quite important to how the RBA think, is probably about that level that you said, 3.25, 3.3, whatever that happens to be, roughly. So we've got interest rates above neutral. And by neutral, what that means is that it's an interest rate that neither restricts nor stimulates economic activity. It's the rate that everybody's happy with. So when rates are above that, it's restrictive. It means that people, they're hunkering down. They've got to pay more than they'd like to on their mortgage debt and all that other stuff and their borrowing costs. When rates are below that, I've got relief. I'm going to go out and spend and get the economy growing again, like we saw the pandemic when interest rates were crazy low. So I think she'd sort of say, can you see 100 points of rate cuts in total? She might say that if we have to get the rates back to neutral, she probably wouldn't be this explicit because she doesn't want to give forward guidance. But if inflation is under control over the next year or two, there's a few more rate cuts to come. That if we do get 2.5 inflation, or even a little bit below, if we get unemployment 4.2, 4.3, GDP hovering at 2 rather than 2.75%, they're going to trim them some more. And can I see 100 points? Look, I can see 100 points of cuts. It will not be a smooth path. Every meeting they go 25, 25, 25. It'll be a cut, a pause, cut, depending on that inflation number that comes out quarterly more than the monthly numbers.
So just to finish off, do you think that the interest rate, the rhythm of interest rate changes up or down, and also the period between rate changes has been perhaps structurally changed as a result of COVID and probably even the GFC to some extent? Are we looking at structural change, or are we just looking at just getting ourselves back into that rhythm?
Look, I think that's a fantastic question. Something has changed. Something has changed, and a number of people mentioned the effects of technology, artificial intelligence, and those things on the economy, that we are getting, let's call it machinery or to do stuff for us. And one classic example is banking. Who has a checkbook anymore? Who uses cash anymore? So that structural change should have improved the efficiency of banks, and it has. It unambiguously has. They don't have tellers there filling in forms and all that other stuff. So that changes the economy, which changes the need and the urgency and the magnitude of interest rate ups and downs. If we take out the pandemic where rates were cut, for obvious reasons, and that was so that's still in people's minds, and it's a misleading thing to look at. We've got to look at where we were, even as you said, the GFC. My hunch is that I'll answer it this way. My hunch is that over the next 5 years, if we look at the average Australian cash rate, it'll be in the low 3% range. There'll be periods like now, it's above that because inflation was too high. And maybe in 2 years' time, it'll be 2.5% because, the Trump tariffs have hit the economy and we've got a problem occurring because immigration is too low, heaven forbid, And so I think that that's going to be more the norm. So we're returning to still, 4 or 5 or 6 rate hikes and cuts, but at a lower level around that 3-ish%. So down to 2 when things are crook, back above 4 when things are booming.
So I sort of agree. And I think you and I had this conversation a long time ago, maybe like half a dozen meetings ago, where we thought 3 seems to be that magic number for a whole lot of things. GDP, wage growth, unemployment.
Yes.
Maybe 3 is being a bit optimistic, but definitely inflation and perhaps even cash rate.
Yeah,
or the official rate.
Give or take half, 2.5, 3, 3.5. Yeah, that's a really nice way of putting it. And when we deviate from 3, let's say things are too hot, too cold, depending which measure you're looking at.
But that in itself is a structural change, I think, because
yes, back in the day it was 5.
Yeah, totally. So
that magic number was 5% unemployment. Wow, that's low.
Yeah.
And 5% cash rate. Yeah, that's what we got used to 6 and 7, heaven forbid. Things have changed.
Structurally, it's sort of, it's sort of changed its position. Yep. And this is a, really nothing of anything, just a thought, thought bubble. But, and you and I just sort of shooting the breeze now. But I think that structural change from 5s to 3s, putting aside all the COVID crap and everything, but just the new, let's call it, I hate the word, new normal, let's say it's 3 territory. I actually think another structural change will be there won't be 5 or 6 rates up or 5 or 6 rates down. I think it'll be like, but subject to not being some disaster that we have to deal with. Yep. But if it's just normal economy, I think we'll see 1 or 2 changes up and 1 or 2 changes down. Like it'll go 3, 325, 350, 3, 2.75, 250, and it'll just sort of hover around that period. Well,
it'll probably stay there for longer before
I wish it would. I'm hoping that's like we don't have this volatility because that it gives you and I something to talk about every night. But I think from a point of view of all these things like business confidence, consumer confidence, etc., I think we need to get to that territory where
stability is a good thing. In fact, I'm speaking to the converted here, I'm sure. One thing that business doesn't like, and this is in the conversations I have with a lot of business people of all sorts of colours and stripes, whatever, in a way, and this relates to things like the carbon price and things, in a way they don't care what the policy is or superannuation policy, whatever it is, just don't change it every 5 minutes, government of the day. Yeah. If we have a carbon price, okay, that's in, I'll work around that. Oh, now it's been repealed. Oh, now it's coming back in. Oh, now we're having nuclear. Oh, now we're having just, that volatility in that sort of policy is something that businesses hate. So they can live with a policy that's in place that doesn't change.
But I'll quickly finish off on this because we don't want to bore our listeners. But if that is correct, and I agree with you, therefore, and given the way governments poll today, does that mean then we're not going to have any real budgets? Is that the reason why we're just going to have budgets like we just had? Like, because, they want to poll. I mean, they want to get reelected.
They want to get reelected, yes. And
they poll and they find out exactly what you just said. And they go, let's not change anything. Let's not make any big ballsy changes. A la Costello, Keating, etc.
I fear you're right. The only thing that I'll say that can overcome that is when you get someone who can sell the story really well. And as I said, if whatever happens at the election or whatever the person, and it is a personality, I think, has to bring the electorate along with you. And that's what Keating and Costello did with the GST tax reform, tariffs, all that stuff that occurred, floating dollars and banking deregulation. They were out there arguing the point till they were blue in the face. And there was a lot of resistance to a lot of those changes, don't you? So, we think,
I do remember that.
The people, no, you can't let the foreign banks in here. Oh, no, you can't let the bloody non-banks come in.
Well, remember when 2000 July 2000 when the GST came in, we fell in a hole between houses stopped getting built, mortgages stopped getting lent because everything was 10% more.
Yep, and that sort of was so that. And it was still a good reform.
Yeah, no, totally.
Absolutely essential reform. Arguably should have been a bit more bold, if you like. But the thing, I'd like to see a salesperson, a political salesperson, come and say, this is what we need and why we need it, and they'll argue the case about why. Okay, I'll be a bit radical for a second. It's why taxes should increase. Nobody's going to sell that politically. And I don't want to pay more tax either, But if people are told, we've got to pay a bit more tax to cover our budget deficit, to cover our ageing population, maybe they'll begrudgingly support it. But I live in hope.
A good one is, I'm going to reduce income tax if I'm going to increase GST.
Exactly. That trade-off, yes, correct. That's one that a lot of people talk about that, yes, I think so.
But we haven't.
It's going to be. I haven't heard that argument for many a long day.
Well, no, maybe tonight you and I are both going to get surprised. Maybe
maybe.
The Dutton's going to come out and sort of say we're going to do that, but I doubt it very much because they do the same polling that everyone else does, and they want to win elections just like everyone else does.
Yeah.
Kouky, all will be revealed in our next meeting, which is
middle of May.
Towards middle of May. You and I meet a couple of days before the RBA, and we'll see a lot of numbers. And I know you'll be emailing me straight after the April numbers come out.
Holy smokes!
This is
they did this.
This is good. Good on you, mate. See you.
Thanks,
Kouky.
Mark.